Welcome to the Australian Property Investment Podcast. We tackle the big questions in property investing. Our guests are industry experts, and we're fortunate to pick their brains on the challenges that investors often encounter when growing their property portfolio. Welcome to the Australian Property Investment Podcast. Let's start investing. G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. I'm your host, Aaron Christie David, and I run a mortgage broking business called Atelier Wealth, where we specialize in helping property investors start out and scale up their property portfolios. And as on that journey, we are on a mission to help more Australians reach their aspirations of building not only their own quality property portfolio, but building intergenerational wealth through property. Now, if that sounds a little bit fluffy, what that means is you put the gas mask on yourself, you help yourself financially, which means you can then in turn help your kids get into the property market, because we think it's hard now. Just wait till our kids are a little bit older and it's going to get extremely hard for them as well. So that's what I really mean by putting down strong foundations and building a good quality financial future for you and your family. Now, on this journey, each and every episode, we bring in someone that I call best in breed. So someone that's been there, done that, lives and breathes property and plays with a pretty straight bat. And today's guest ticks all the above, and on top of that, he's a great bloke. Paul Glossop from Pure Property. Welcome to the show.
Thanks for having me, mate. Very generous. Very, very generous introduction indeed.
Not at all, mate. I could keep going. I could turn you red in the face if I really wanted. No, mate, we've had the pleasure of knowing each other for quite a long time. Started our businesses around the same time as well. The circles are very small, especially in property and finance, and you get to know cream that rises to the top. And, you know, having read your book, having seen your business, having seen your results for our mutual clients, mate, I'd say we've got a great amount of respect for what you do and how you do it, and keen to kind of get inside your head, because I know there's plenty that goes on inside the Glossop head there, mate. So before we kick off, how's life treating you?
Mate, I think as we were just catching up prior to getting live on air, mate, there's always fun stuff. I mean, you and I both sort of run similar aged families with kids, etc. So that in itself is probably the primary focus.
Never a dull moment. Yeah.
Never a dull moment, mate. So there's always going to be something that's taking priority there, whether it's sport, whether it's school, whether it's a combination of those things. Kids parties after school, before school sports, mate.
The circuit of 4-year-old birthday parties, mate. I'm on that pretty hard at the moment.
Absolutely. You start to realize how to cull them, and the circle does get smaller slowly but surely, I'm finding. But that's it's part of the enjoyment of being a young kid, I guess, mate. So you don't want to take away those funs and laughters. But no, mate, life's excellent. We could always, I guess, retreat into the things that could go better, but I'm typically a pretty glass half full type of person. Mate, I think the property market in general has probably been a really key barometer on a lot of people's lives over the last couple of years, and we've definitely ridden the highs, and some have ridden the lows of the last probably 12 to 18 months, and probably now starting to realise that those lows don't last too long. The highs also don't last extremely long, and you sort of got to focus on what's probably happening right now, which is pretty steady, pretty predictable, and pretty normal.
Let's talk about that. So yeah, we've kind of ridden that wave, which is the highs, and now we're coming to a different market, which is, what have we had? 12 rate rises, 2 pauses recently as well. So I guess you talk about the barometer. When you're talking to either prospects, existing clients, for example, what's the sentiment out there that you're hearing and feeling as well?
I think if I was to generalize it and sort of crystallize it into more of a general term or a general consensus, the majority of new clients that we speak to, and also existing clients for that matter, is that, okay, we're kind of entering into the waters that we kind of expected to see long term, which is, you know what, there's some good areas, there's some bad areas, there's some good opportunities, there's some probably pretty average opportunities, there's some pretty big risks for some people, and there's some traps. There's some scenarios that I think that are probably playing out for those who bought at the very heady heights, not only on price, but also on expectation of 2 to 3% retail interest rates. And that might have been their first venture into property, that are probably realizing now that, hey, it's not buy essentially potentially a $1 million blue chip property that was yielding 2 or 3% and it having neutrally geared, and that's normal, and then seeing it grow 10% in value year in, year out. they're the people which no doubt you've seen come across your desk now who are probably saying, hey, hang on a second, either my loan has reverted or is about to revert to variable, and I'm sort of talking a 6 to 6.5% rate, and now I'm having to figure out how to find $25,000 a year if that's just one property. And some people with a scaled up property portfolio who didn't necessarily probably put their focus on that long term, hey, the average is probably 5 to 6% interest rate. Do your math on that. They're the ones who might be seeing a little bit of red symbols and freaking out a little bit. But I'm probably pretty proud to say the majority of our clients weren't set up that way, because essentially we know that you've got to take a long-term view of property, and typically a long-term view is 10 to 15 years as a minimum. Yeah. And then you've also got to figure out what the last 10 to 15 years of interest rates were in that time as well. That's probably what you're going to pay. So do your math on that. Do your math on those growth numbers.
Well said. Well said. So I guess that doesn't take away from the pain that some people are probably experiencing. And I guess this is where, and you may be getting some newer clients, and certainly we're seeing it, people scratching their head going, I've sat on the sidelines for quite some time. I thought 12 rate rises might push prices down. And look, you might see that in some pockets, but on the whole, the market's still pretty steady. We're seeing marginal drops, for example, but where we are this time last year to now, it's holding pretty steady. And so people are going, well, hang on, what is it going to take for me to get into the market, for example?
Yep.
And then you got some people that are probably on the fringe that are maybe offloading a property or two that may be hemorrhaging on cash flow as well. But to the people that are trying to get in, that you're going, well, we're not seeing those real dramatic drops in house prices. What's your read on that? And I guess what's the tell on house prices for the future?
Yeah, well, the first part, I think, not to say that it's a I told you so moment, but when you look at property data, there is always going to be pundits, and sometimes they're well known and big name economists who, and also banks who come out and say, and this time last year, mate, we both saw the same headlines. That it was the same headlines at the start of COVID. We're talking 15-20% reductions in the next 12 months. And to be fair, if I was sort of assessing that versus 2020, and we heard those potentially 20, 30, 40% drops in prices on the back of what would be a pandemic, then I probably believe the sentiment a little bit more this time last year, because markets just can't sustain 20, 30% annualized growth, coupled with very low yields, and then all of a sudden rates go to 6%. They can't sustain it, and there will be a correction. That correction happened really quickly. But I think the reality of the way we temper it, and we always have tempered it since essentially the 50s and 60s, and even going back to the 20s and 30s, is that we are a migratory country. We essentially always will be, until the point of that we've exhausted all the areas that we can live in this country. So we've got 400,000 or 500,000 people moving here this year. Yep. The reality is that's going to be pretty close next year. So I think that's what's essentially sustained the demand side. And the converse to high interest rates that we've also seen, and also inflation, is that building becomes extremely expensive and inaccessible for a lot of first-time developers, and even mid-scale and mid-tier developers, and even the higher-end market is seeing some issues with regards to being able to make projects feasible. So what that means is that we've got far less property coming to market, more people coming into the market. We've got a supply and demand issue. So people will buy property regardless of how expensive that funding is to get, because we've also got close to 20% rents increasing over the last 12 months. So you sit in the rental market, you're paying an extra amount of money well beyond what you were 12 months ago. You sit in the buying market, you're paying more than what you were 12 months ago. So I think the market is quite normal. We've got a supply and demand imbalance. Money's expensive, so we're not going to see a huge amount of people pile in. But if we're sort of seeing people sit on the edges and say, how do I get there? Well, it's kind of what it was, I would say, 2016, 17, particularly on the East Coast, where we had a pretty expensive market comparatively, and people were sort of figuring out, how do I get in? I've just seen 30, 40, 50% growth. If we're talking about Sydney and Melbourne at that time, people go down the pathway of guarantor loans. They start at a much, much lower and more accessible price point. They potentially consider rent vesting and go down the pathway of saying, do I buy an investment and rent where I want to live and keep my finances constrained? So they go down the pathway of figuring out there's got to be different ways to get in, as opposed to just saying, well, I want to live in that beautiful affluent area as my first purchase. It's unaffordable, so I'm going to essentially go to the Daily Telegraph and I'm going to feature in a page 3 article. As we've seen basically every month for our lifetime. So, mate, I think that's where, I guess what I was saying earlier is that we're pretty much in a normal part of this cycle. The last 2 or 3 years wasn't normal. And realistically, will it repeat itself? Unlikely, not in our lifetime. So based on the data, I don't expect we'll see that again.
Yeah. You just mentioned something before around when you do the numbers around construction, small scale developments, for example. I know we've probably scratched the itch. Bernie and I have looked at our numbers, so many opportunities to come up, and we'll do our numbers through our rough spreadsheet, and we just can't seem to make the profit, that's the time and investment, to the return on investment as well, on time and the financial investment. You've obviously embarked on a few yourself. So are you seeing some opportunity like this? I guess if there's someone listening that's going, hey, look, I am a aspiring developer, or want to take on a small scale development, whether it's a duplex townhouse or a division of 4-pack, for example. Are there opportunities like that at the moment, or is it a wait and see type approach and sit on this until the tide turns? Because under that is, I guess, builder volatility as well. So how do we kind of temper that with, we still need to build and there still needs to be more development done?
For sure.
But from a rate perspective, from a ROI perspective, we're just not seeing that stack up. So what are you seeing?
But it is a really interesting space, I find, sort of the new build / developer space, where I find the markets are actually doing okay and have basically been fine this entire dip between sort of circa anywhere between April and July last year to where we kind of are now, where we saw some markets saw a reduction of 10 to 15% and now corrected another 5% since then. The owner-occupier areas in that sort of middle ring / upper ring, or middle ring to blue chip markets, have been the markets, especially if you're developing products which are going to be more of an owner-occupier finish. So that typically means you have to spend more, you have to speculate a bit higher, because the price is going to be a lot higher to get in. But in saying that, the simple duplex sites, and if I talk about specifically Sydney here as an example, which might be a residential property that's an R2 zone, 600 or 700 square meter, 15 meter frontage, classic duplex opportunity. Those types of properties, even in the higher end markets, regardless of what the entry price is and the build price, they're the markets which the margin is still quite skinny. So for me, is the juice worth the squeeze, so to speak? It's very hard. I look at this stuff all day, every day, and I look in a range of markets. Probably, if I'm talking about the entry level for the land, I'm talking as low as probably $1 to $1.5 million, as high as $8 to $10 million, and everything in between that. If you're going from a 1 into 2 lot duplex scenario, those markets and those property types are very hard to make sense sub 2 million. The higher the price, this is probably a little bit of secret sauce that I've found in my time, and we've developed a large number of high-end properties over the last 5 years. The secret sauce I find is that the actual construction costs of things like simple duplexes, if we're talking about that, they get higher and higher to a point, but there's a point where they don't really get much more. And if I talk about some basic numbers for anyone listening, you sort of get to the point of getting up to around about possibly $4,000, $4,500 per square meter construction costs. That might go up to $5,000 to $6,000 per square meter construction costs if you're sort of going down the pathway of basements, lifts, and really high-end finishes. However, if you're getting from that side of things, it doesn't go to $8,000 to $10,000 if you're in simple dual occupancy duplex construction. So I guess the reason why I highlight that is that if you're buying a $3 million block of land and you're going to build a $3 million duplex, as an example, there are markets out there which have an end sale of circa $4 million per duplex, even in today's market. And there's a very, very strong appetite for people who want to move into those properties. Now, simple back of the napkin math, that's about a 20% gross ROI. Strip out your GST and strip out your holding costs, you might be talking more like 13 to 15% net. But, you're talking potentially $1 to $1.5 million in net profit before tax in that type of really simple, and I say really simple, the actual construction and process is quite simple. Your risk is quite mitigated because you're essentially going down the pathway of building 2 properties that are going to be sold to 2 owner-occupiers. You're not speculating on markets which people don't have funding. You typically got cash buyers in those types of scenarios because they're moving from a much more expensive, potentially waterfront or larger property and downsizing. The other part, which I probably briefly will speak to on that, the 1 into 3 and 1 into 4 lot type of options in those R2 zones, they're also quite, they're quite, more often than not, I should say, they're the ones that tick the boxes. If you're talking about buying, developing, building, potentially selling to investor or owner occupier in that entry to slash medium level, and that they're a lot rarer as an asset, and you typically want to find the infill locations because they're typically those 1,000 to 1,500 square meter blocks that might have bigger frontages or on a corner, but they take a more sophisticated developer and typically a bit more funding. And as you know, mate, that's when you run into different banks potentially don't have an appetite for that type of funding as well. So then you're down a commercial lending pathway, and all of a sudden you've got different costs that come into that, and then you need more experience. So yeah, I think the investment stock, if I was to categorize it, those high-rise apartments in the edges, fringes, in those 10, 15, 20-story apartments, brand new off the plan, mate, I look at those numbers all the time, and I look at them and it freaks me out because I just don't know how people really consider ever entering into that type of development. And likewise for those duplexes in those entry-level markets, because right now when funding's hard, you just aren't getting people who are going to compete over each other to pay more because the markets aren't exclusive, and there's a lot of them that can be repeated or replicated. It's those higher end markets over the last 12, 24 months, which have still held steady as long as you deliver the right product in the right area.
Yeah, well said. Well said. That's pretty much to a T what we're kind of seeing at the moment, which is the aspiring developer or maybe got one or two projects under their belt, probably just aren't seeing that return, for example, and just going to look on, and it's almost, it's perpetuating itself because they're sitting and waiting. Others like them are sitting and waiting as well, but the market is crying out for more supply, for example, more builds to be done exactly around that whole migration piece. But it feels like we're a bit of a stalemate here, going who's going to go first and who's going to kind of cut their margins to bring more product onto the market. But the demand is there, and I think quality can't be understated. Like the cheap and nasty stuff, we're just seeing it's either being discounted or it's not selling as quickly, versus quality. To your point around great locations, just doesn't go out of fashion, and a high finished, high quality, high spec property. We're just seeing, you think about properties that maybe aren't selling, but these ones are having multiple bidders. They're highly sought after as well. So yeah, if you're thinking about it or you're pondering it, maybe just the extra few dollars to build a quality product in a quality area is going to get you the bang for your buck they may be looking for.
Yeah, completely. And it probably takes a few rounds of doing it to realize that you can't underestimate what a good discerning buyer will pay more for. Things like west aspects, northeasterly aspects. Making sure that if you're selling to downsizers, getting that property dead level, making sure that the tapware, all those basic finishes, people look at brand names if they're spending $3 or $4 million, and that's where people sort of go wrong, to just cut a few corners here and there and try to save 1 or 2% on the end cost. They're the ones who look at the specification sheet. They look at the tile choice. They look at the lighting choice. They look at essentially the architectural design, where the natural light's going to be. They're the things which it takes time to figure out, but that's probably one of the things I've learned over the years, is that if you're in decent areas that are more affluent and you've got aspiring or downsizers who are going to be your end product buyers, you spend that little bit extra, swallow your pride and think that, okay, I spend X and am I going to justify a return of Y? You're not renovating a red brick in the West that's going to be an entry-level buyer and trying to flip it for a quick, tidy profit. You're developing a high-end product that someone's going to want to stand out the front and invite their friends over for a dinner party and spend a lot more money on that property. Yeah. So, yeah, that's a space which I think there's opportunity. Yeah, know your buyer 100% and know your math. And that's a challenge. The lower-end markets, you simply just can't. I can speak to a subdivision I did in Brisbane about 7 years ago, 4-bed, 2-bath, 2-car garage, corner block subdivision, kept the front house, built a house at the rear, turnkey, delivered that product for $192,000. Now, you could imagine going to the market for off the plan, and when I say low spec, it was still stone bench tops, etc., brick construction, slab on ground, etc., and a bit of landscaping. But it was a 200 square meter house. To try and build that now is about $400,000. So essentially, that same product's doubled in value as far as the actual construction costs. And the market hasn't grown enough to be able to justify those types of developments. And that's where that challenge for those entry-level markets are right now, is that developers are looking at those same numbers and they're like, I can't make this work. So supply is going to be constrained. So existing property in those markets is actually still doing quite well, and existing rentals is doing well because supply is not coming out of the woodwork either. Yeah,
well said. Well said. I mean, when I was looking back on some of the stuff that we've done in the past, kind of when we started, we had the interest only cliff, if you can recall that as well. Now we've got the fixed rate cliff. There was the APRA changes, for example. And then when things tightened up around the Royal Commission, I'm like, there's never been a dull moment, really,
No,
in the last few years since we're
absolutely.
kind of kicked off. We've had at the very start, I think we kind of rode the wave when property prices were booming, like 2014, 15, 16, and then things kind of tapered off a little bit. And then we came to the Royal Commission, and then more recently around COVID, it boomed, and then fixed rate cliff. So the outlook from what you're seeing and kind of riding these waves at the moment, what does the next, maybe, well, let's look shorter term, like the next 6 months. So as we kind of round out this calendar year coming into very early next year, the spring selling season, we always know that things kind of pick up in the lead up to Christmas. So everyone's the imaginary deadline, everyone's trying to buy and settle before Christmas. And then we come into that lull period, which is nothing really happens till Australia Day, things return back to normal for Feb. So that when more listings come on. So what's your read on the market for, say, the next 6 months coming, especially out of the fixed rate cliff? Or is it just a bit of a beat up like we had with the interest only, or is there some merit to this as well?
I personally think there is definitely some more merit to this than just some good media hype. I mean, they've done a good job at it, don't get me wrong, but I think the reality is there's definitely going to be more hurt that's going to be coming in the coming 2 or 3 months, in particular for the bulk of this tranche of fixed rates to variable. And then next year, there's also probably half the amount that come off this year by the looks of it as well. I think from what I can see personally from things like consumer sentiment and also consumer sales, we're pretty much in a consumer recession at the moment, regardless anyway. So
we can dig our head and say it is a spending recession. So like it had to have worked. I mean, look at we go to a cafe a couple of times and like everyone's just getting takeaway coffees. Like no one's dining in. And
absolutely, I was out for breakfast yesterday with my wife, and we had a bit of a glance and like this place is typically you have to wait around 10 minutes, even on a random Tuesday morning where kids drop off and some parents go and catch up because sometimes that's the only time you get. But I definitely noticed there was probably a quarter of the seats empty, and that cafe is rarely empty. And I think that's a theme. So I think for me, that's the part which is happening. And I think that'll be consistent. So regardless whether you're in an affluent area, entry-level area, middle ring markets, and irrespective of what city or state you're in across Australia, I think that's something that's been seen. We're not in a boom or bust scenario where we've got a resources boom and potentially a construction bust. There's still money being spent. I think we've got still a very well-funded pipeline of large-scale infrastructure in many states across Australia. So the government, state and federal have committed a fair bit of money, and that's going to be keeping, I think, a bit of a baseline below us going into potentially a technical or too deep a recession as a country. But I do think we're going to be probably a balanced market if I was to assess it for the next 6 to 12 months. I don't expect we're going to see this market drop out. We will probably see a bit more supply into spring as far as people selling, and that's a combination of seasonal, but also probably people pushed to the limit of what they can afford to hold in their portfolio if they've got extra assets which they just can't afford to hold. That will happen a bit more, I believe, and it'll taper the market. But supply is not going to be ramping up exponentially anytime soon. So we're still going to see a lot of people come into this market. We're still going to see a deficit of around about 200 to 250,000 dwellings in Australia over the next 2 or 3 years. And we're still going to see a shortfall in rents. Now, we're hearing that the Greens are essentially doing their best to talk about rent freezes. Good luck with how that policy is going to change the market in general. It'll have a short-term blip, and long-term it'll create more chaos than they actually really, I think, truly understand. But we're going to keep this normality for the next 2 or 3 years. If we start to see rates start to reduce in an 18 to 24-month period, and if the inflation numbers start to get well below what they're essentially forecasting, as we know, mate, that's typically where you start saying, drivers, start your engines. It's game on again for the next wave of growth.
I think even just the talk of rates, sorry, mate, even just that talk of rates coming down just starts to add fuel to the fire in terms of like people get that confidence back up going, I can see the light at the end of the tunnel. And that's when we know that by the time they've already cut rates, the market's already started to move from our previous experience, right?
Absolutely. And I think we only saw yesterday Macquarie were talking about cutting now their fixed rate products, 3, 4, 5 year products. Cutting. So they were starting. I mean, this conversation started. So, it's kind of the inertia is already there. We've sort of pushed all the way to the top. I think the jury's out whether we'll see another rate cut from here, rate rise rather from here onwards. If there is, it won't be much more. And I think we're kind of at the point now where the conversation towards the back end of this year, I would pretty much put a good wedge of my confidence into the fact that we'll see more media talking about rate cuts. And then next year we'll probably start to see that conversation talking about a booming property market. And then, the conversation will, depending on this Labor scheme and if they get it through for the future fund, the $10 billion future fund for 30,000 properties that they're trying to build over the next few years, that'll start to become a very large political hot potato again as well.
Yeah. So I guess reading between the lines, I'm certainly going to put any words in your mouth, but you go, right, we've got this window of 6 to 12 months where we're not going to see prices increase significantly, given, I guess, we've got fixed rates coming off. Maybe people just waiting to see what happens and maybe the prospect of rate cuts to come. And then once we start to see rate cuts eventuate, maybe let's give a 9 to 12 month window, and then consumer confidence starts to come back in. We see rises in house prices. It almost feels like we're coming into the golden window of buying. Is that a fair way of looking at it?
But I think for those who can afford to access debt right now, and do their math on genuinely what the holding costs are, and are comfortable with that, and are comfortable with a bit of shortfall, because it's very hard to find a positively geared property, and
correct,
that's
a quality positive geared property in this market.
Exactly, and that's the part for me, is that throw out the window 1 and 2 bedroom apartments, highly regional markets that are speculative in nature, even commercial assets which might show a crazily high net rental yield, but are a retail shop front of 40 square meters in a regional town with a 1-year lease, and look great for that first 12 months, and then all of a sudden you're scratching your head. Good quality 10, 20-year buy and hold assets. If I'm personally speaking, I've tried to load up my own portfolio in the last 12 months as much as I possibly could, because you just know that these cycles play out. But again, whatever I've personally bought, I've not bought with the intention of saying, I'm going to make a killing over the next 24 months and I'm going to flog it. I'm still looking at it saying, what do the numbers look like for me to hold? This still goes into my 10, 15, 20-year horizon. I might develop that property a bit sooner. That property is going to be developed, then hold, sell some. But ultimately, it's saying the buying is good. And when the buying's good, the rest of it typically takes care of itself, as long as the cash flows are within your comfort zone.
Yeah. I know you've been pretty open and transparent with what you've been buying, or your personal strategy as well. And I'll be open with ours. Like, we're buying a commercial property for our own business, for example. Time is right for us. The opportunity is right. So we're kind of venturing to that space. Commercial offers some really good, especially if you're self-employed and you're renting a premises, then to buy your own site, then does make sense in how you do that as well. But from your own perspective, what have you been acquiring? What does that look like? And how have you gone about your asset selection?
Well, if I go back to how we built our portfolio, mate, we started buying the best part 15 years ago now. And that included entry-level market assets, initially was across parts of southern Sydney, out towards southwest Sydney, and predominantly freestanding houses, a little bit down south past your way, mate, down towards the Shell Harbour region.
Great areas.
All those properties bought and hold, own them all still today. And they were basically residential assets which had a 5 to 7% yield at the time, which was kind of what was the norm back then. That obviously dropped as interest rates drops, but to be honest, that'll probably start to become a bit more of a bounce. Around 4 to 5% will start to be needed, and will likely play out as we see these rental growths. That then ventured into markets across Brisbane, a little bit further south and a little bit further north of Brisbane. All assets which we've bought, I think we probably bought 7 or 8 assets across that market over a probably 2015 to 18 period. And all those properties still owned today. Some of those were basic subdivisions and granny flat additions for properties which were just intended to really ramp up cash flow. And they've all done predictably quite well. They had some soft years, they had some ridiculously good years, but the growth's been sort of between that 7 and 12% per annum annually, with yields of 5 to 7% again. That's then ventured into assets over towards Perth, property that's been bought in Melbourne, and then also probably more in the last 3 to 4 years, ventured into both commercial as well as larger development sites. So we worked on a very large commercial site in Sydney again last year, which was intended, and this probably goes back to you've got to be fluid with your strategy, but we bought it was about a $4 million industrial site last year in southern Sydney, with the intention, it was about 1,200 square metre site, the intention of building a 3-level 12 warehouse industrial complex.
Nice.
Got it approved via CDC method within 3 months. numbers at that time, interest rates started increasing. Square meter rates from a development side of things were probably where the bigger issues sort of arose. We're doing our math on about 2,000 a square meter. That blew out to about 3,500 a square meter after going through a tender process. Ended up selling that site only about 6 months ago. And sold it for about 5.5, so made a tidy profit on it. But that wasn't the intention. The intention was to build, but that build ended up blowing out by a fair few $1 million and kind of made the profit pretty close to what we would have made if we just sold the asset as it was anyway. So that was a scenario where you're saying, well, you sort of swallow your pride and say, look, we would have loved to build this, but funding becomes expensive, and I don't necessarily want to hold something that I built just to say I built it. I want to doing this for profit's sake. And then buying probably more higher end duplex sites, as well as 1 into 4 lot subdivision sites, which we've picked up in the last probably 18 months. Picked up one in Cronulla in southern Sydney. That's sort of a $3 million site, $3 million build, $8 million sale. And then 2 1 into 4 lot subdivisions not too far away. Again, circa $3 million purchase, $3 million build, about circa $8.5 million sale. The intention of all of those, though, to be fair, is to probably sell a portion of the site and keep one. So one thing we've always done, we've done a few previous developments similar, and we've always tried to keep skin in the game. So we try to keep the profit maintained, or essentially the profits built into the property we hold. Typically hold it for a minimum 5 years, and then use that for leverage for future assets. And that's been a strategy which has allowed us to propel, because we're holding equity. We're not necessarily crystallizing the gains either, and still keeping cash flow relatively high. And we've also got one larger subdivision up in the Tweed area, which is a 2 hectare site, which is also it's in council now for a 22 lot subdivision. So that's something we, again, going through the motions of, do we fund this 22 houses? Or do we look at saying, do we just take a price on the property? Because we bought it very, very cheap. We've added value to it exponentially already by getting approvals and subdivisions, as well as civils, etc. But again, that's been a 2-year project, and the property still looks basically the same as it did, other than some curbs, gutters, and a bit of sewer. So from the outside looking in, you're like, well, you've held a lot of debt there, but we've probably increased the value of the property by a couple of million by simply just going through the process of knowing what could be done to the property and maximising it, with the intention that if we do build it, we'll probably sell a portion, keep a portion again. And mate, we're basically open. We're fluid to looking at other options, but we've probably got the best part of I think four active projects currently, and there's probably about 40 odd dwellings in those 4 projects that we're building. So we've probably got our hands full for the next couple of years.
Well done, mate. Thank you very much, and I really appreciate you being open and transparent, mate, with what you've got on your plate as well. But what I hear from that, and if you've kind of tuned in and you're hearing the numbers and you're going ping ping, there's some good quality, high caliber numbers. It's been very much like a stepping stone strategy, right? Like you had to start with, and I know where you probably bought those early stages were we're not the. I mean, we're both products of Southwest Sydney, so it's like,
absolutely.
well, hang on. They're not terrible areas, but they're not where you want to ideally end up long term. So it's like, well, you buy here, but that's ultimately got me to the blue chip areas of, say, Cronulla or up the coast as well, or south coast as well. And I go, well, most people try to start there, but you got to start smallish and then try and build yourself up. Take the learnings, take the lessons from it, take the wins, and then try and scale up your portfolio, rather than going, I'm going to go balls deep on a blue chip area like Cronulla, and then your exposure is very high. You're probably running out of borrowing capacity or trying to max out your equity, and they're really hard to value because premier or prestige properties they're not easy to do a desktop valuation, for example, whereas your properties in Blacktown, Western Sydney, Southwest, they're probably easier to get uplift or valuations on as well, percentage wise.
Yeah, completely, mate. And I think that that's always been, and it still remains, one of the biggest things I try to reinforce for any of our clients is that if we're starting with a first purchase, everyone aspires to be typically somewhere beyond what their first purchase will allow them to get into. And that's okay. I mean, we need the drive to get us to where we want to get to, because if you were given it and you had the ability straight up, I personally, I mean, I might be biased in saying this, but I'd be bored shitless if that was something that came my way. And I was like, I'm 25 years old and I can buy what I want where I want. I mean, what's the rest of life worth? I mean, you don't go off and make, decisions or push yourself and, all those aspirational things that we all, I guess, moved into over the years. But the biggest thing for me more than anything is that buying what you can afford in areas which you know are going to have consistent population growth, consistent demand, and there is always going to be a market for it, it will grow in value. Mark my words. I mean, you need to swallow your pride and say, yeah, look, yeah, yes, this isn't your dream home or your dream location, but if the numbers make sense and you're intending to hold that property, and I mentioned at the start, I've been investing for well over 15 years now, and I own the vast majority of the properties were bought 15 years ago. The intention is that these are stepping stones, and they will continue to be stepping stones. Now, whether that means that you're going to build a 10, 20, 30, 40, 50 property portfolio, or whether it's intended to go from 1 to 2 to 3 over potentially a 15 or 20 year period, and essentially is going to supplement your retirement, it's still going to work out as long as you can play that longer game, buy correctly, and make sure that your cash flows are balanced. They're pretty much your 3 non-negotiables. And outside of that, we talked about this off air as well, is that you've got to have time for life. And I'm not here to say that people, you want to be fully entrenched in property and numbers, and that just takes away every single ounce of your waking existence. You really want to do it to be somewhat passive. So, the time that you're doing this, you're really enjoying the things that you want to enjoy, regardless of what that is.
Balance. I love it. It's a great message. I think sometimes the investors that want it too much and like they're chasing it, it's like it just keeps eluding them, for example. And it's almost like when you're dating, you're desperate. It doesn't work when you're more laid back. Opportunities come to you. And I feel like that's a great analogy for property investing, which is sometimes the accidental investor, the ones that aren't trying to get it revalued every 6 months, or they're not pushing and pushing and pushing. A little bit of patience met with the right level of tempo and assertiveness will get you the result, rather than the desperation and trying to really scrape the barrel and trying to buy cheap and quantity, which is, like I think you mentioned it, swallow your pride and buy quality over quantity, for example, as well.
Mate, absolutely. And I think that's if I was an aspiring investor and doing my math or setting my goals and objectives, the thing that I would take out of my vocabulary immediately is how many properties do I want to own? It's immaterial. It doesn't mean a single thing. Really try to figure out where you want to be, what numbers you need to be there, and then essentially you make up the assets. There's ideally as little as possible to get you there. For me, it's like running a business. It's like mechanics. It's like engineering. The least amount of moving parts, typically the less that can go wrong, and the better the outcome. So for me, when we're building portfolios, we're not talking about 10, 20, 30 assets for the vast majority of people. People have capacity. Some of our clients have well and truly the capacity. Even then, you ask the question saying, is that going to be something that you want? Because you've got to make sure you're aware that when you hold 10, 20, 30 assets, you've got 10, 20, 30 small businesses, and they need attention, and things come up, and refinances have to happen, and running repairs, tax time, all these things become more complicated.
I agree. I think one of our mutual clients, when we did their review, like, I thought this was meant to be passive, and like I feel like I'm hands-on. I was like, welcome to the world of property investing. It's quite active, and between property management, between tax, between your loans side, there's a little bit to juggle here as well. So there's no the word passive. I'm like, hang on, we need to shake that up a little bit, because it's quite hands-on. It's quite active, unless you want to kind of just sit at the wheel and not take part in growing your portfolio. That's what growth is. Any type of growth. It means you got to kind of grab by the horns a little bit and take control. Otherwise, it's just gonna be one of those things that eludes you as well.
Yeah, completely, man. And I think if I was to leave the conversation on that part, as far as what are you doing it for, and we talked about the next 12 months, 24 months probably being a little bit more of a steady as she goes type of market. If you take a backward step and zoom out of almost every single major capital city in Australia over the last probably 10 to 12 years, you've actually still seen in the vicinity of 70 up to 150% capital growth. Now, we talk about the fact that properties go through these cycles, cash flow starts to get tight when interest rates go up. We're talking about running repairs, maintenance, which will happen irrespective of what the market conditions are doing. Rents are now booming. So those who have held property for a very long time are rubbing their hands together saying, cash flow is increasing day in, day out right now. But you've got to sort of say, for the vast majority of investors, that long-term, 10, 15, 20-year growth cycle is what you're really trying to get the outcome of. And if I look at the product of the properties that have performed best for me, there's no secret that the properties I've held the longest. It is very, very simple. And I think if anyone can take anything away from this, is that the longer you hold the property, the more you enjoy that property, because typically the numbers will just sit you back and say it's all worth it. You know, I get a new hot water heater, tenants move out, I've got a running repair, I've got insurances have doubled over the last 3 years. I still look back at those land tax bills, you know, rent freezes, all these other things. Yeah, this will consistently happen. And we know that in the next 5 years, there's going to be more policies which will create more confusion, more angst, more frustration. But take a zoom out. If you held that project for 10, 15, 20 years and you look at those numbers, you'll remind yourself, this is why I've done it. And I could sell the property and I could take a profit and it was worth it. Or I could not sell the property. I could just swallow my pride and say, this is part of holding a property. There's going to be uncertain times, but the numbers will still make sense.
Well said. Well said, mate. Great way to end it. Sage advice always, mate. I know you got great content when you're putting it out there. I know the goal very much is not to peddle property or products. It's to go, hey, look, we can raise some awareness and build a better caliber property investor as well, mate. The better educated you are, the better the results you're going to get. So I want to say thank you very much for your time, your energy, and your input, mate. Really appreciate it.
No, thanks for having me again, bud.
Appreciate it. If you want to get in touch with Paul and his team, like I say, we have no commercial agreements with anyone in our business or any guests that come on. So I really feel like if someone like Paul resonates with you, you can reach out to him and his team. And their results definitely speak for themselves. So I want to say thank you very much, Paul. That's a wrap for another episode of the Australian Property Investment Podcast. If you found that helpful, leave us a review. It just works wonders for us to get into more people's ears and on more people's playlists. But more importantly, if you have a question that you'd like answered by a guest, then please drop us a line and we'd love to help out as well. That's a wrap. Until next time, take care.